Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of non-dollar rate strategy, and I'm joined today by our global market specialists, Nevruzi and Joann Spadigam. So another central bank focused week. So let's start there with you, Jan. I think a pause was fairly consensual heading into this week, and that's what they delivered. Can you talk us through, I guess, the kind of key takeaways from this week's Fed meeting?
Sure. So, like you said, it was very widely expected that they're not going to raise rates at this meeting, and that's exactly what we got. The Fed kept rates unchanged, but more importantly, we got the forecast for this year, next year, all the way up to 2026, and their long-run estimate for the long-run rate is those leaned on the hawkish side. I have to admit, this year for 2023, the median projection showed that the Fed is looking for another interest rate hike, which means we would get one either at the November or the December meeting. Just to clarify, that's not our base case, but that's what the forecast had. Then for next year, the dots showed that the Fed expects to cut only by 50 basis points. 12 out of the 19 voters put their forecast at only 50 basis points. The remainder were virtually all at like 75 or 100. So that just kind of puts us in a situation where the Fed previously expected 100 basis points of cuts for next year. Now they've lowered that amount to 50. It was a close call, but nevertheless, it has this kind of crosses this almost psychological barrier of 5% into next year as well. And then the year after that showed an unchanged amount of cuts, again, like 50 more basis points. Obviously, the absolute number there went up as well. The long run estimate, contrary to what we heard from in our conversations, and there was certainly some that investors considered a risk point, but the long run estimate remained unchanged at 2.5%. So now the so-called, whether we call that the neutral rate or just different current view of what the long run rate will be, maybe some, like a little bit abstracting away from what the neutral rate should be. It was 2.5% unchanged. I think that was pretty clear to me because Powell made it pretty openly stated a couple months ago that they're really not looking to adjust that rate at this stage. Why hawkish? Well, markets were anticipating about 75 basis points of cuts to be priced in for next year, up from the 100. You could kind of gauge that futures, for example, if you look from December as we headed to the meeting, it was basically at 75. Now at 50, I imagine that rate will anchor between the 50 to 75 point range until we start seeing some softness data. Once that happens, I do believe that we would, break out of that and start pricing more and more cuts. But the press conference was, I'd say, pretty neutral. Perhaps not one of Chair Powell's best ones, but it was kind of lingering the point of let me make the message that we don't plan on cutting, but we have to be data dependent. We really care about bringing inflation. I suppose a transitory mistake was such a fumble that they don't want to repeat it, take chances. So easing is always easy, but keeping rates higher, at least forwards, is a little bit harder to do. And I think they did a very decent job at achieving that if that's what they were going for. So initial reaction was flatteners, but then the curve steepened. Today we're seeing a very substantial steepening of the curve as the front end kind of finds its range and everything else. All the selling duration happens in the longer parts of the curve.
You talked about their preference for kind of keeping those forward rates higher, and I guess that's a sort of coordinated global central bank narrative right now. The sort of restrictive for longer, we're close, near, at a peak, but they're going to stay at these levels for some time. How do you actually think that might play out? I guess leaving aside the rest of this year, like you said, they're going to be data dependent. Maybe there's a little bit more tightening to come, but beyond that, their dot plot showed only 50 basis points of cuts next year. Is that in line with your thinking?
We definitely think the latter. We think that narrative of high for longer will be challenged into next year as well. We expect this mainly on the back of this credit crunch that we can see from Fed surveys, from the lending data. There has been a slowdown in credit creation in the form of, or at least access to credit, and which will likely weigh on the economy. So we are looking for a relatively mild recession, nevertheless, from in the second part of the year, which opens us up for rate cuts starting from May. We kind of see them in like 50 basis points increments, which kind of brings the year-end rate to something in the 2.5-2.75 range, right? So like it's a pretty big, substantial drop, well below what the market expects, because the market doesn't really have rates coming down below 3.8%, 4%, period. That's where they remain, and anything below that would be kind of performing against forward. So I think once they start cutting and once the economy slows down, it's always much easier on the way down. And when you start, let's not forget that the Fed has a dual mandate of inflation and unemployment. We think inflation is trending in the right direction, and once unemployment starts trending higher, it is hard to stop that. Hard to stop that momentum. So in real terms, the Fed will be tightening into a slowing economy. So once they turn around, I think that shift can happen rather quickly. And once it happens, it's, in my view, certainly not going to be only 50 basis points of cuts. But, we're recording this right after the Bank of England. So they, go into that meeting, we were expecting a dovish hike, but instead we got a hawkish halt. So how does that score up with your views of the bank?
Yeah, well, I think if we have any regular listeners that heard me say last week that I didn't expect the inflation data this week to be a game changer unless it was, a big miss on either side. Well, that's ultimately what we ended up getting this week. What felt like probably a game-changing print on inflation, which really tipped the balance in favor of no hike from the MPC, the Monetary Policy Committee of the Bank of England. We thought previously that the decision was sort of finely balanced, but ultimately, the still kind of absolute levels of tightness in the labour market, despite it showing some relative loosening of late, and wage inflation that was still, not consistent with their target, would probably push them in favour of a 25 basis point hike. Obviously, the downside, big downside surprise, especially on the core print in inflation this week, kind of muddied the waters a little bit. And after that, it became a very close call. So a hawkish hole, I suppose, in line with, similar to what we've heard from you, Jan, on the Fed, was what was delivered. And I guess there are two kind of elements to this. There's their actions in terms of them not hiking, and then there's their words in terms of the hawkish rhetoric. They didn't hike, but they kept the language and all the forward guidance in the statement unchanged. Now, to me, that feels slightly at odds with the guidance that they've been giving kind of in the run-up to the meeting, this sort of Table Mountain metaphor about being close to the peak in rates, but also, they've had the same forward guidance for many months now. This is the same forward guidance that they had in June when they hiked 50 basis points, as they have now in September where they didn't hike at all. So it seems that a little odd that they haven't updated that. But to me, I would place more emphasis really, I think, on their actions, and the fact that the majority, and it was a slim majority, but the fact that the majority of the committee didn't see enough evidence to tighten rates today, to me suggests that they're unlikely to see enough evidence in 6 weeks' time. It feels like the bar has been raised, particularly given the composition of the MPC shifts marginally in favour of the doves, we think. So this was John Cunliffe's last meeting. We certainly didn't have him down as being a hawkish dissenter for this meeting, but he was, surprisingly. So, to the extent that his replacement, Sarah Breed, and we don't know a huge amount about her yet, but at her parliamentary hearing in front of the Treasury Select Committee, she sounded quite consensual and, perhaps might be criticised of this sort of groupthink element to the BOE. She's long been part of the BOE as part of their Financial Policy Committee. It seems more likely that she would vote with the majority rather than dissent in a hawkish direction. So at the margin, maybe that gives a bit of a dovish tilt to the composition. You also have the fact that, as inflation continues to come off, which we think it will gradually over the next couple of months, monetary policy is kind of de facto becoming tighter without further hikes needing to be delivered because real rates are rising. And like I say, it just feels difficult to me to see where the evidence for further tightening will come from. We now call this the peak in bank rate, 5.25%. We think that's it. And we also think, it's very similar to what you've said, Jan, that we can understand why would they have this kind of hawkish element to the communication in terms of they don't want the market to price in too much of an early pivot today. That kind of undermines the tightening that they're delivering. But we do think that this kind of restrictive for longer narrative in the UK is probably going to be challenged earlier and in a bigger way than the market's expecting. The market in the UK currently has the first 50 bip cut. And that's what we're thinking in terms of the size of the first cut, 50 basis points, not priced until November. We think we could get 50 bips in August and 50 bips in December. So there's quite a gap, I suppose, in terms of what we're expecting of loosening next year versus what the market has priced in.
I like that, punchy. And I guess it's an end of an era for the Bank of England, right? Like, what's the hike since end of 2021? I think they started. Was it the first hike?
Yeah. Fun fact that I worked out today is that officially, since I've been covering the UK, this is the first Bank of England meeting that they haven't hiked at. So I've never seen a BOE easing cycle.
I'll admit, it does feel better as a strategist to talk about it's going to be a hike or no hike as opposed to 25 or 75. So I'll take this direction. But they also announced on top of the rate decision their updated plans for how they plan on presuming QT and the stock that they plan on writing down. So can you talk to us about that part of the announcement?
Yeah, so we got the annual vote on the pace of QT in the year ahead. They announced that would be 100 billion, so they'll run down the stock in total by 100 billion. That's slightly higher than last year, which was 80 billion. And I guess it's slightly higher than our expectations of 95 billion and at the higher end of the kind of consensus range of estimates. But that range was really very narrow at 90 to 100 billion. So I don't think this is kind of particularly market moving, although you could say that, as listeners will know, a large part of our bearish view has been driven by the net supply outlook. And obviously QT is a big contributor to that. So, at the margin, a slightly faster pace of QT. The only other thing that we discussed a lot in kind of client conversations over the last week or so is about whether they would change any other operational details of QT. So at the moment, they sell equally in sales proceeds terms across 3 maturity buckets. There was some discussion about whether they would change the kind of parameters of those maturity buckets or whether they would change the way in which they sell so they don't sell equally across the curve. They didn't do either of those things. They didn't even suggest that they had been discussed. And that was in line with our base case. But I certainly think that there were some out there that were looking for maybe a bit more of a change on that.
And just to add up everything what you just said and translate it into what happened to the market and the market reaction that we got afterwards, how does that fit with your views, for the gilt market going forward?
Yeah, so I kind of said earlier that, there were sort of 2 parts to today's MPC, Thursday's meeting. There's the kind of actions and then the words. Our view is very much that the actions speak louder than the words, whereas the market seems to have taken its cue much more from the kind of hawkishness that the guidance wasn't really watered down at all. They still have this kind of asymmetric element to their guidance that they talk about. To me, we don't rule out the idea that, there might be some further tightening, and the data in the UK has been somewhat erratic of late. And clearly the BOE's reaction function is very much linked to kind of spot inflation data right now. So, I don't rule out that should we get a reversal of some of this month's kind of downside surprise next month, then maybe the chances of tightening increases. But at the moment, I would put that really at only about 20%. So some way below what the market has priced in. And like I said earlier, I think that the market's underestimating the extent of cuts next year. But I don't think we're likely to kind of trade that cut pricing until we're more comfortable that we're near the peak and we can see the data coming off more clearly.
And briefly, I want to shift gears a little bit and step away from the Bank of England, but because we also got public finance data from the UK this morning, and it did show an undershoot in borrowing borrowing needs. So one of the drivers for your short gilts view has been the huge amount of supply from the UK. How do you reconcile this undershoot with the anticipation for more and more large supply, and how does that impact your view, if at all, the long curve, I guess?
Yeah, so we've had this undershoot for a couple of months now, or really all fiscal year. We've got nearly data for half of the fiscal year, and borrowing so far has undershot the OBR's projections. Now, if you simply extrapolated the trend that we've seen for the first half of the year into the second half of the year, that would imply, a not insignificant undershoot versus what the OBR projected at the beginning of the year. But I think that kind of misses the point somewhat in that, those undershoots have been diminishing. So extrapolating the trend probably overstates the extent to which you might get an undershoot on full year borrowing. But also perhaps, extrapolating the trend, misses the point a little bit, I suppose, on things that we've discussed before in terms of, from a net supply perspective, QT is increasing, but that means that the cost of QT is also increasing. The OBR penciled in 30 billion in terms of the cost of QT for this year. We only have data for the first quarter of the fiscal year, but that already showed that the cost of QT amounted to 15 billion. So we're running at kind of double the run rate, essentially. Debt servicing costs are high and rising. And of course, the main point here really around any fiscal headroom that might be created is that we do expect it all to be kind of reused and recycled in the run-up to the election, which we expect to be next year in the UK. That doesn't necessarily mean that all fiscal headroom is reused in the autumn statement. We pencil in the election in autumn 2024. So there's essentially two fiscal events, we think, between now and then, the autumn statement and the spring budget next year. And, the government would probably want to save their kind of biggest vote-winning policies until the spring budget. But some of that has to be recycled in the autumn statement, we think, and ultimately will all be recycled. Now, for gilts, it probably means that, we're not talking about the autumn statement being a significant catalyst for a major sell-off. We're now, the undershoots, I think, in borrowing so far suggest that there's not likely to be a huge upward revision to the borrowing needs in November. But I've long been of the view that we don't need a kind of major supply event for us to reach our bearish target in 10-year gilts of 4.6%. I think if anything, we learned at the beginning of this fiscal year that, there's a kind of announcement effect of supply, but also a flows effect, and that, supply fatigue can quite easily weigh on the market once you have the DMO and the BOE kind of coming to the market more days than not, essentially most weeks. And I guess to reconcile that with our gilt view, we've long had this kind of 4.6% fair value, but we had sort of at the beginning of the summer said that we saw enough reasons that could overshoot and that we wouldn't look to fade the cheapening in 10-year gilts until it got to 4.9%. Most of those overshooting risks were related to potentially bank rate going higher than we might have thought because the data was surprising to the upside, and B, those supply risks surprising to the upside. Now, maybe, given that both of those risks appear to have moderated somewhat, the extent of an overshoot or the extent to which we see gilts cheapen beyond 4.6% might now be a bit more limited. But it doesn't change our overall bearish view and that fair value target of 4.6% in 10-year gilts. That's probably enough on the UK. So let's switch over to you, Joann, in Europe. We've had, as ever, a flurry of ECB speakers since the meeting last week. Have we learned anything new from any of those, or anything that would kind of change your thinking after we caught up after the meeting last week?
The most interesting kind of comments were on Friday, which came right after the ECB meeting, where there was a suggestion that higher inflation figures could potentially mean that rate hikes could materialize this year. And I think that was a fairly interesting comment, just on the back of a press conference that did seem fairly dovish, and the suggestion that we were at the peak in rates. I also thought this was surprising given that we did see more neutral comments from ECB kind of hawks before the meeting. But in terms of what that does for our view, I don't think it changes very much. We did kind of mention last week that we do think that some premiums should be embedded in market pricing for a hike this year, but that we did not think this would materialize for a number of reasons. Firstly being really the communications that we have gotten, which do suggest the bar for really hiking is quite high. The inflationary picture is quite interesting. We will be getting inflation prints next week. Obviously, there's a bit of concern around energy prices again with oil prices higher, but we do think that the kind of base effects should push down on inflation for next week and also going forward. So that inflationary kind of surprise that might trigger another hike does seem to be fairly muted for now, or the risk of that does seem to be fairly muted for now. We also get growth numbers tomorrow from PMIs, and I do think that the PMIs should again continue to suggest that the growth picture in Europe is continuing to be fairly weak. So those two factors have kept our views of the ECB fairly intact, but it does seem like there is some kind of hawkishness coming across from the ECB speakers, not just in terms of this kind of inflationary comments that we got, but also in terms of more about balance sheet normalization and how that might kind of proceed moving forwards.
All right. Thank you guys for joining me. Lots to discuss this week, and I'm sure there'll be lots more next week as well. Just a reminder to our listeners, if they like today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.